we are on Financial Plan, Telling Your Story in Numbers, Chapter 10, from Business Plans That Work by Jeffrey A. Timmons, Andrew Zacharakis, and Stephen Spinelli. So if the preceding plan in your verbal description of the opportunity and the way you will execute it, the financial plan is the mathematical equivalent. The growth in revenues speaks to the upside of your opportunity. The expenses indicate how much it costs to deliver the product or service. Cash flow statements serve as an early warning system for the potential problems or critical risks, and the balance sheet represents the resources required to put the delivery system in place. That said, generating realistic financials is one of the most intimidating hurdles many entrepreneurs face. There's a temptation to hire an accountant to create your financials for you. That's a big mistake. Although the process is painful, the deep learning you require by struggling through the numbers helps you understand the business. Always remember, the numbers in the financial statements are a reflection of the actions you take in your business, and so you learn what actions drive revenue and costs. You learn how cash flow can go negative even if you're growing and profitable. Besides, you will be presenting your plan to investors and bankers. You will lose credibility if you cannot explain the numbers. This chapter will provide you with a broad overview of how to generate realistic financials. We will highlight a dual approach to building your model, comparable analysis, and build-up technique. Entrepreneurs should use both approaches, and with work and skill, the two approaches will allow an entrepreneur to paint a textured picture of the financial structure of the new venture. Creating initial estimates. The comparable method. Entrepreneurs are notoriously optimistic in their projections. One term entrepreneurs overuse in the business plan, especially the financial plan, is conservative estimate. History proves that 99% of all entrepreneurs are amazingly aggressive in their projections, and professional investors recognize this problem and often discount financials up to 50% from the entrepreneur's projections. That action greatly affects the valuation of your company and means you will have to give up more equity for the needed financing. How do you prevent this unhappy surprise from happening? Validate your projections by comparing your firm's pro forma financials with existing firms, i.e. comparable method, actual performance. If you can convince investors that your projections are reasonable and refer to existing companies as a basis for your beliefs, you will get a valuation closer to what you expected. Obviously, no two firms are exactly alike, and if you were to launch an online bookstore, it would be unlikely that your firm would mirror Amazon.com perfectly. However, the comparable method does not mean that you substitute another firm's financials for your own. It means that you use that as a starting point. Early in the process, variances will emerge that require analysis and explanation. Some of the variances will highlight your competitive advantages. Others will be red flags marking weaknesses. Many of the variances may be explained by the stage of your company's development. New ventures go through a learning process that translates into less efficient use of resources early on, thus higher expenses. You need to understand why the differences exist. The first step is to start with your benchmark company's common sized income statement through the use of percentages for all line items. With the revenue line equaling 100%, work your way down the income statement and express each line, cost of goods sold, gross margin, etc., as a percentage of the revenue. So the Vermont Teddy Bear Company, VTBC, is a good comparable for Fireflies. So Exhibit 10.1 here shows Firefly and VTBC side by side. So we have the income statement of VTBC, and we are saying the VTBC made 37.3 So we're taking VTBC of 2001 and comparing it to Firefly of 2007 as the same point, and so we're saying the variance is 0% on the revenue line. The Firefly revenue will be 24.2%, 24.2, and VTBC was 37.3 at this time. Now the cost of revenue for Firefly will be 6.4 million or 1,000 or whatever the percentage is. The numbers here mean, that's what I'm wondering. It doesn't say on this income statement if it's in thousands or millions, but let's just say thousands, since they're a teddy bear company just starting out. I'm still trying to understand what they mean by the variance percentage here. So they have the different numbers on the income statement: revenues, cost of revenue, gross profit, sales, marketing, product development, G&A, operating expense, so on, for both for Firefly and for VTBC. They've written percentages for each one as a percentage of the revenue. So let's say that the cost of revenue is 6.4 and the revenue, total revenue, is 24.2. So the cost of revenue is 26% of the total revenue. I see. Okay. So basically for each line item, we've taken a percentage of the total, and then we are comparing what percentage of our total versus what percentage of their total it is for that line item. So in the case of Firefly, the cost of revenue is 26% of their total revenue. But in the case of VTBC, the Vermont Teddy Bear, the cost of revenue is 36% of the total revenue. So the variance is minus 9%. And so what that means is that we are saying that we will have less cost of revenue than VTBC. So the question is, why? How are we so much more efficient than VTBC, for example? So the negative numbers here are in sales and marketing. So we are assuming we're going to spend less in sales and marketing, and we're going to spend less in general and administration, and we're going to spend a little bit more on product and development. So Firefly is assuming that their total OPEX is going to be almost 10% less than VTBC as a percentage of the revenue here. We're also assuming a very negative tax amount. Okay. So we can see that Firefly's gross margin is 9% higher than VTBC. This may be explainable by the higher production cost of VTBC. VTBC operates its own production factory in the United States versus outsourcing the cheaper factories in Asia. Okay, so that explains why VTBC would have a higher cost than Firefly. An area of bigger concern is Firefly's operating expenses are 10% lower than those of VTBC. That suggests Firefly may be underestimating the cost of generating its sales. If you recall our discussion in Chapter 6 of the amount of sales per employee, it appears that Firefly will need to build a larger infrastructure to meet its sales goals. Remember, gross variance, positive or negative, from the comparable companies will draw investors' attention and should draw your attention. If you understand these discrepancies, you can address investor concerns with confidence, increasing your credibility. If we were potential investors in Firefly, we would question its labor projections. If Lauren couldn't explain her lower sales and marketing expenses, satisfactorily, we would be hesitant to invest. VTBC relies primarily on direct distribution, and so Lauren might be able to argue that its marketing and sales infrastructure should be greater. However, that higher expenses probably would be offset by gaining higher gross margins, and so VTBC gets the retail price through its direct channels. Even considering Firefly's unique distribution strategy, we think she underestimates how many sales reps she will need to support those channels. Individual company benchmarks are a good foundation to build on, but we also would look at industry averages. The Almanac of Business and Industrial Financial Ratios and Industry Norms and Key Business Ratios published by Dun & Bradstreet are excellent sources to use as starting points in building financial statements relevant to your industry. Secondary sources also break down industries by firm size. For example, smaller firms have common size percentages different from those of larger firms. Thus, these sources help entrepreneurs build income statements by providing industry averages for cost of goods sold, salary expenses, interest expenses, and so on. Again, your firm will differ from these industry averages, but you should be able to explain why it differs. So this is a comparable method. Now let's talk about the build-up method. The second method is the build-up method. This approach derives from the scientific finding that people make better decisions by decomposing a problem into smaller parts. For financial pro forma construction, this is relatively easy. The place to start is the income statement. Identify all your revenue sources, usually the various product offerings. Instead of visualizing what you will sell in a month or a year, break it down to the day. For example, if you're starting a new restaurant, you should estimate how many customers you might serve in a particular day and how much they would spend per visit based on the type of meals and beverages they would buy. In a sense, you're developing an average ticket price per customer, then multiply that by the number of days of operation in the year. Once you have the typical day, you can make adjustments to take account of cyclical aspects of the business, such as slow days or slow months. You then could multiply your estimates if you were to open up a chain of restaurants. Once you have gone through a couple of iterations of each approach, you should be able to reconcile the differences. One schedule that is particularly powerful in building up cost estimates is the headcount schedule. In Chapter 7, we saw a headcount table for Firefly. Next, assign average salaries to these employees, and then funnel the salaries into the appropriate income statement lines. We also must remember that employees cost more than just their salaries and wages. You will have to pay employment taxes, social security, etc., and possible health insurance and other benefits you wish to provide. This is sometimes called the labor burden, and you must multiply the salary by a burden rate. 15% is usually a good first estimate. Breaking down to this level of detail enables entrepreneurs to be more accurate in aggregating up to their real headcount expenses, which tend to be the major line item in most companies. I probably would argue it should be more than 15%, but for the labor burden, but it's up to you. The financial statements going through these exercises allows you to construct a realistic set of pro forma financials. The financial statements that must be included in your plan are the income statement, cash flow statement, and the balance sheet. Investors typically expect 5 years of financials, recognizing that the further out one goes, the less accurate the forecasts are. The rationale behind 5 years is that the first 2 years show the firm surviving and the last 3 years show the upside growth potential. The majority of the new ventures lose money for the first 2 years, therefore the income statement and cash flow statement should be month to month during the first 2 years to show how much cash is needed until the firm can become self-sustaining. Month-to-month analysis shows cash flow decreasing and provides an early warning for when the entrepreneurs should seek the next round of financing. Years 3 to 5 need to be illustrated only on an annual basis, as this communicates your vision for growth and a textured understanding of the forces you believe will drive the future of the business. The balance sheet can be on an annual basis for all 5 years, since it's presenting a snapshot on the last day of a particular period, but it will inform the investors of the magnitude of the resources you expect to marshal to fulfill your vision. The key to constructing the actual financials is to build the statements on a spreadsheet and linking the different financial statements together. This can be difficult, but Frank Moyes and Steve Lawrence at the University of Colorado have developed an excellent Excel template that you can download from their website. Okay. The link here is http://leedsleads.colorado.edu/vplan/sptools.html. Hit the financials hot link. So this is Frank Moyes and Steve Lawrence at University of Colorado. All right. Description of statements. Once the financial spreadsheets are complete, a 2 to 3 page explanation of the financials should be written and should precede the statements. Although you understand all the assumptions and comparables that went into building the financial forecast, the reader needs to have the background spelled out. The explanation should have 4 subheadings: overview, income statement, cash flow statement, and the balance sheet. The overview section should highlight the major assumptions that drive your revenue and expenses. This section should map several of the critical risks you identified earlier. The income statement description goes into more detail about some of the revenue and cost drivers that haven't been discussed in the overview section. The cash flow description talks about the timing of cash infusions, accounts payable, accounts receivable, and so forth. The balance sheet description illustrates how major ratios change as the firm grows. For instance, talk about the inventory turn ratio. How long do you hold inventory before it's sold? This has a major impact on the company's cash position because holding inventory means that the cash is tied up. Firefly's financial plan. 11.0 The financial plan. Firefly generates revenue by selling comfort creatures and comfort kits through 3 primary distribution channels: institution, specialty retail, and direct sales. Institutional channels constitute the majority of sales, starting at 85% and falling to 66%. Wholesale to specialty stores will be the next most important channel, and direct through the website are expected to account for only 5% of the sales. After closing the next round of financing, Firefly will ramp up its operations by expanding its efforts in these channels aggressively. Actuals summarizes Firefly's limited operating history. This communicates that the company has tested its business model and is ready to ramp up. Firefly has been operating since September 2002. During this initial phase, we have proved production and the salability of our products. Exhibit 11.1. To date, the company has sold 126 comfort creatures, 75 comfort kits, totaling almost $10,000 in revenue. Upon closing the current round of financing, Firefly will scale up production and sales. The financial pro forma projections suggest that the business model has a high potential. Exhibit 11.11 shows the total sales through December 2002. It's a little visual of the total sales. So on the first column, we have Jordo's with the number of units sold and the sales amount, and the kits, the number of units and the sales amount. And then on the different columns, we have the months: September, October, November, December, showing the total sales of each. And then we have a line totaling them up. Total cumulative sale is $9,990. 11.2 Income statement. Sales are driven by product lines, channel penetration, and geographic expansion. In year 1, Firefly will focus primarily on philanthropic organizations, institutions, and specialty retail stores in New England and New York. Toward the middle of year 1 and the second comfort creature, Mushi, and Comfort Kit Divorce will be introduced. In year 2, the company will expand to Chicago and San Francisco, as well as continue to develop new creature and kits. In year 3 through 5, Firefly will continue its nationwide expansion and add new product introductions. Exhibit 11.2 shows the revenue projections by distribution channel for the next 5 years. So offer more details on revenue drivers. This shows and allows the reader to judge whether the revenue forecasts are reasonable. So Exhibit 11.2 is the revenue projections. So here we have years 1 through 5. We have 2003, 4, 5, 6, 7 as years on the columns. And then we have institutional sales, comfort creatures, number of units, price per unit, and the total number of units sold. So notice that the Unit sales explode from 14,000 units in 2003 to over 300,000 units in year 5. Lorien would argue the growth is a function of new product introductions, additional channels, and geographic expansion. Make sure you understand what drives your sales growth. Okay. So the test case, when we did sold 40 units, 60 units, 10 units, we sold them at like $40 a piece. In this larger vision, we are selling them at $32 a piece. I wonder if that scales from 40 to 32. Hopefully it does. And then it shows the total revenue based on the number of expected units sold. So goes in 2003 from 459,000 to almost 9.7 million in 2007. And that was just for the Comfort Creature sales. Then there's the Comfort Kit sales, where we again have the number of units and the price per unit, and we do the same kind of exercise. Then there is the total institutional sales. Okay, I see. So basically we did the institutional sales, broken it down to the Comfort Creatures, Comfort Kits, added all that sales up over the 5 years. Then we're doing wholesale sales for Comfort Creatures, number of units, price per unit total, Comfort Kits for number of units, price per unit total, and then computing the total for the wholesale market. And then we're doing the same thing for direct sales to come up with the total direct sales revenue. And then the total revenue is a sum of our institutional, wholesale, and direct sales revenues. So, attempting to validate high gross margins because Firefly expects potential investors to question them, it is always wise to validate major assumptions as well as possible. Gross margins vary by product and channel. See Exhibit 11.3. Gross margins are significantly higher than industry average due to premium prices and unique distribution channels. COGS, cost of goods sold, is higher in year 1 than in subsequent years due to minimum charges on shipping goods from China and minimum charges on fulfillment from our warehouse vendor. After we achieve some scale, the overall COGS drops dramatically. In the first year, the operating costs are 79% of the total revenue. Legal fees, salaries, promotion, and advertising will account for the bulk of the costs in the first year. The construction and maintenance of the e-commerce website will be the largest promotional expense. By second year, the company will still be focused on increasing promotion and adding members to the management team. The experiences in the first year and the additional people on staff will increase the operational efficiencies of the company. By the second year, operating costs will be down to 44% of the revenues. Exhibit 11.4 shows some of the income statement for the first 5 years. Okay, so 11.3 shows the gross margins by channel. It shows Comfort Creature, price per unit, COGS, GM, and the percentage. Gross margin. Okay, so what is the percentage? Okay, so percentage is the percentage of the total revenue. So the Comfort Creatures give us 23 million gross margin, and the Comfort Kits give us 26% gross margin. But the percentage of revenue for the Comfort Creature seems to be higher than the percentage for Comfort Kits. Oh, okay, I see. That's not the percentage relative to the revenue, that's just the gross margin percentage. So there's a higher margin compared to COGS on the Comfort Creature and lower margin on the kits. So Comfort Creatures are priced at $32. The Comfort Kits are priced at $52. The cost of producing the Comfort Creature is just $9, but the cost of producing the Comfort Kit is $26. And so the gross margin for the creatures is $23, but the gross margin for the kits is $26. And so the gross margin as a percentage is 72 for the creature and 750 for the Comfort Kits. And that's for the institutional ones. The same exercise has been done for wholesale and direct because the price per unit is different. The COGS is the same across the different channels. The gross margin obviously changes as the price is different, and so does the gross margin percentage. Notice the level of detail of expenses coupled with the detailed revenue model in Exhibit 11.2. This gives the potential reader a sense of your business model. It also helps you understand the levers you can pull to conserve cash. For instance, Firefly can defer salaries if cash flow becomes strained. Exhibit 11.4, income statements, years 1 to 5 in dollars. So now that we know our sales and we know the gross margins by channels, we can work on the income statements. So we have our revenues that we pull from the sales numbers that we calculated. We have our cost of revenue, which is a percentage of revenue. And then we have our gross profit, percentage of revenue, sales, marketing, and then we have all the line items for building the company: salaries, benefits, target bonuses, recruiting costs, samples, conference fees, materials, website creation, maintenance, direct mailings, advertising and public relations, all other expenses as percentage of revenue, total sales, and marketing. And then we have in the product development cost, salaries, benefits, graphic design, writing, editing, other fees, total product development cost, G&A cost, salaries, benefits, depreciation, rent, utilities, product liability insurance, legal fees, capex, accounting fees, all the other expenses and revenues. And then we have our total operating expense. We have that as a percentage of revenue, earnings before interest and taxes, interest income, net earnings before taxes, taxes, net income, percentage of revenue. Exhibit 11.5 shows the income statements on a monthly basis for the first 2 years. Revenues and expenses ramp up. So this was the income statement for the 5 years on a yearly basis that we just discussed in Exhibit 11.4. In Exhibit 11.5, we're doing the income statements on a monthly basis for the first 2 years. Revenues and expenses ramp up in year 1 as the company enters the institution and specialty retail store channels. Firefly sales and marketing expenses are higher in January 2003 as the company initiates its efforts. Sales drop off in January 2004 due to the post-holiday decline, although Firefly is less cyclical than other toy manufacturers due to the nature of the product and the distribution channel. It's important to show the monthly statements in the early years to illustrate the seasonality and other factors that might be hidden in the yearly statements. So now we're going to have the Firefly toy income statement for year 1 by month and then year 2 by month. After that, we will get to the cash flow statement, balance sheets, and it's basically a bunch of images of cash flow statements, balance sheets for Firefly. done by month. So net revenues, cost of revenue, gross profit, OPEX, sales, marketing, product development, G&A, total OPEX. All of these in the first column, and then January, February, March, all the way to December, and then a sum for each of the 12 months at the end. And then numbers have been written out for what we expect the net revenues to be, what we expect the COGS to be, expenses to be, and so on. Just like the income statement again. And we can possibly annotate these. I don't think in the book they've annotated the income statements, but if we were trying to remember why certain expenses or things changed along the way in our spreadsheet, we could make some comments. Yeah, so that's basically it. We have this month-by-month income statement. Cash flow statement. Firefly is raising $695,000 in equity financing in year 1 on top of the $55,000 already raised. Series A will close in January 2003 for $320,000. Series B will close in August 2003 for $375,000 in year 2. The company will seek a line of credit to finance inventories and working capital. Exhibit 11.6 shows the cash flow statement for 5 years. Exhibit 11.7 shows cash flow monthly for the first 2 years. And again, the cash flow statement is just a statement like this. I know it's hard to see on the screen, so but in any case, it's just operating activities, how much are the net earnings, depreciation, working capital charges, investing activities, financing activities, increase, decrease in cash at the beginning, at the end, all of these in a cash flow statement. And for the first 2 years, it's again done by month, and for the years 1 to 5, it's done on a yearly basis. And then you can see a line of credit prevents Firefly from running out of cash. Here, it's common for companies to finance their production cycle, but it's harder to do that without an operating history. This is likely why Firefly uses equity in the first year and then seeks debt in the second year. And then the next exhibit is the balance sheet. Exhibit 11.8 provides the overall pro forma annual balance sheet for the years 1 through 5. Accounts receivables will be outstanding an average of 30 days. Plant, property, and equipment consists of computer and office furnishings. All manufacturing will be outsourced. Liabilities will consist of accounts payable and short-term credit lines to financing inventories. The company will use equity for the majority of its startup cost to establish a new niche in children's toy and grow opportunity. Firefly will not pay out a dividend for the foreseeable future. To date, Firefly has raised $55,000 from friends and family. Let's see if there's any other special comments. Okay, so then there's the balance sheet. There's the beginning amounts that we have, and then each year what is the amounts on our balance sheet for cash, for property, for assets, liabilities, and current liabilities, and so on. The balance sheet provides a check if you're out of a balance. You probably have a formula error either in the income statement or more likely in the cash flow statement. So the balance sheet has just been added for the 5 years. There's no first 2 years of month-by-month balance sheet here. And yeah, it's just a balance sheet. So if you don't know what a balance sheet looks like, you can just go to Yahoo Finance or something and just look up balance sheets of different companies, try to understand what goes on in a balance sheet. Appendices, adding bells and whistles. The appendices can include anything that you think adds validation to your concept but doesn't fit or is too large to insert in the main parts of the plan. Common inclusions would be one-page resumes of key team members, articles that feature your venture, technical specs, and the like. Firefly included reprints of the Time magazine and Boston Business Journal articles that highlighted the company. Firefly also includes its brochure and other marketing materials. Due to space constraints, these appendices are not in the book. Chapter summary: financial projections are an art. You can never predict the future precisely, but you need to anticipate what can happen. And so financial projections help you gauge the attractiveness of the opportunity. What is the profit potential? How might the company grow? What does it mean for you, your team, your employees, your investors? In summary, financial projections are the numbers equivalent of the story you have articulated in the rest of the plan. Just like the written plan, the financial statements need revisiting and refining as you learn more about the opportunity. We believe it's imperative for you, the lead entrepreneur, to own the numbers. If you rely on others, you won't be able to make strong decisions about how to proceed or raise money. You need to get started. Although building the understanding financial statements can require effort for those of you who are less proficient in numbers, the time you take to familiarize yourself with the financials is time well spent. Alright, and that is the end of chapter 10. I will see you for the last chapter, which is the conclusion. And then that will be the end of this series of reading The Business Plans That Work by Jeffrey A. Timmons, Andrew Zacharakis, and Stephen Spinelli. I'm Aditya Mittal, and I will see you in the next video.